Welcome to Investment 360, your wrap of the top funds and investment insights in South Africa and beyond. I'm Bronwyn Nielsen. Now, coming up on the show, we chat to Hal George, Director at Old Mutual Investments, about how to achieve inflationary returns in a low interest rate environment with Johan Goos, Portfolio Manager at Absa Investment, later in the show. Remember to follow us on #investment_360. Well, the wheels of the Great Rotation started turning when the US announced a tapering off of their quantitative easing program. Hal George, Director at Old Mutual Investments, will unpack what is really driving this global shift from bonds to equities and from emerging to developed markets. And of course, Hal, let's start with the Fed's surprise decision last night not to begin the tapering process. Were you surprised?
It was a surprise. There's no doubt about that. And Bernanke had clearly signalled that September was the time he would begin tapering. And I think what happened is that he really frightened himself with his comments in May and the effect that had on markets, which really tightened conditions more than I think he was expecting.
Well, of course, we've got equities on the local front hitting all-time highs on the back of that news, and perhaps we're going to see a shift back into emerging markets because of all of that excess liquidity looking for a home. What are your thoughts on the trends going forward from this point? Of course, we have to this point been talking about the deceleration of emerging markets.
Yes, and I think this will make a difference. You are going to see a lot more money flowing through into emerging markets still, and that will have an effect on currency markets and on equity markets and on bond markets, which have really been under pressure since May. And that tightening of policy I mentioned, which I think did surprise Bernanke. And we also shouldn't forget that Bernanke is only 3 months away from the end of his term, and he's going to pass on most likely to Karen Yellen, who's in the dovish camp. And he doesn't really want to rock the boat just before the end of his term, so he wanted to keep things on the straight and narrow, and easy money has been part of that. And so that's going to flow into emerging markets, and that can only be of benefit.
When we talk about emerging markets, we need to focus on China and whether China is going to be the growth engine going forward for the globe. What are your thoughts on that front?
I think it can continue to grow. I mean, China has grown at 10% per annum for 30 years. It has been the most extraordinary growth story the world has ever seen. And it's now entering its phase of transition from an export-led and investment-led economy to a consumer-led economy. And that's a perfectly natural transition for any emerging country to go through. All the Western economies went through it, but it doesn't mean it can't grow. What it does mean is that those workers who have moved from the rural areas into the cities and have now bid up wages, need to start spending those wages. And so we're going to see more of an emerging middle class in China, more of a consumer story, and that will drive both China and other emerging markets. And China will continue to be very important in that story and will continue to grow, we would think, around about the 7% area.
Japan, your thoughts on Japan? There are some players in the market that feel that Japan is an explosion waiting to happen, so to speak. Do you believe we're going to see momentum coming out of that territory? Their latest data point, not too bad from a GDP perspective. Yeah,
the GDP numbers are coming through quite well. The X numbers are pretty good, and we're starting to see a little bit of inflation in the system in Japan at the producer price level. So Abenomics is starting to have an effect. And we would expect that to continue. And if Japan really does resume its growth path, then that's going to be an important driver for Asia. A lot will depend on the Japanese banks. They've continued to be undercapitalized for many decades now, and so they need to take this opportunity to rebuild their balance sheets and really support the recovery in Japan, which will be more of a domestic-led recovery through some consumer lending.
With the Fed's latest move, asset allocation globally, what do you think is going to happen?
I think we need to step of the Great Rotation which is occurring, and we are great believers in that framework for the next decade, and we're starting of that from bonds into equities. We mustn't forget that bonds have been in a bull market for the last 30 years, and bond markets are as expensive as they have ever been in history, going back more than 140 years. At the same time, equity markets are relatively inexpensive, and if we see growth coming through, that will support equity markets. And equity markets tend to move in very long-term generational cycles. And it's our belief that the next 20 years will see the next great bull market in equities globally. And that on a 20-year basis will be driven by the emerging markets in the southern hemisphere and the emerging consumerism I've talked about led from China, and also debt liberalization in emerging markets. People will get mortgages, they will get credit cards, and that will drive consumer spending in the southern hemisphere and will drive equity markets there for the next couple of decades.
On the local front, are you expecting to see the momentum that's been created in equities continuing going forward? Can we go higher and higher on a weekly, monthly basis?
Well, people worry when markets hit new highs, but almost by definition over long periods of time that's what they continue to do, because equities are a real asset and they grow in line with real GDP. So I don't see any reason why South Africa cannot continue to benefit from the growth in the southern hemisphere. The easy money situation will be an important part of that. And South Africa does have a problem with its twin deficit situation. So it's not in as good a position as perhaps some other southern hemisphere economies. But even so, if easy money leads to some recovering commodities, then of course that will benefit South Africa specifically.
What are your thoughts on the US economy going forward? There obviously was much hype around the fact that we're seeing traction in that territory, and now that has stalled slightly with the Fed's decision not to pull back the tapering as we were expecting. Does it mean that the underlying economics in the US are potentially worse than we've been getting used to?
No, I think the economy in the States is fine. The US did what other economies always should do, which was to take the hit on the bank balance sheets early. What you need to do is write down your bad debts as quickly as you can, recapitalize the banks so that they can then go on and lend again to the real economy. And the US has been leading the way in that. So the banking system in the States is in much better shape than most other economies, and that should continue to drive consumer spending, where people's personal balance sheets have been repaired to a great extent, and that's why you're seeing the housing market activity we're seeing and car sales. What we saw over the summer was something of a summer northern hemisphere lull for the States, and that's what frightened Ben Bernanke. And I think he really was taken aback by how the degree to which monetary policies were tightened as a result of his first utterances in May about withdrawing stimulus, and that's why we saw what we saw overnight in terms of just holding fire on that until the economy is on a slightly stronger footing. But the momentum is still there, and the medium-term story for the US economy is actually still pretty good, particularly backed by shale gas and their drive towards lack of dependency on overseas players for their oil revenues.
What about the Fed's credibility going forward? I didn't speak to one market player that wasn't on sides with the fact that we were going to see the tapering beginning last night. And as you say, it was first mentioned in May. Surely this is a bad investor relations job.
I think it is. And I don't think Bernanke planned it this way. But I do think he was surprised at the setback in the near term he saw in the last couple of months due to the tightening in monetary policy. And we mustn't forget in the States that mortgages are priced off the long bond yield, not short-term rates. And so seeing that the long-term bond yield go up by a full percentage point, that really choked mortgage lending near term. And that's the end of the market which Bernanke, try as he might, can't really control. So that did take him by surprise. So I think he put his PR to one side and did what he thought was the right thing.
Hal, thanks so much for your time. Hal George, Director at Old Mutual Investments. After the